In less than 24 hours, $900 million vanished from crypto markets. Not from hacks, not from rug pulls, but from liquidations. Traders wipe out instantly, and what's scary is that this wasn't an accident, it was structural. Today, we are talking about crypto's liquidation and why this recent $900 million event matters far more than most people think, because liquidation aren't just traders losing money. They're a warning signs, and signs about leverage, about market fragility, and about how exposed the entire system really is. So, the problem with massive liquidation isn't just about the numbers itself, it's what that numbers represent. So if we again look at CoinGlass, okay, we can see the majority of the liquidation is on the long side, meaning people got wrecked trying to predict that Bitcoin and other cryptocurrency will increase in price in the future. But this liquidation event is different and quite unique compared to the other liquidation event. Most liquidation event is usually caused by a liquidation cascade, where a market maker consciously targets a specific stop-loss price to cause the first wave of liquidation. This liquidation causes the price to fluctuate more, causing even more chaos. When the dust is settling, the market maker will either buy or sell back the asset, causing what we now call a scam wick, a huge wick in the direction of the liquidation. This one, however, is seemingly to be from the underlying spot market. CryptoQuant's net taker volume metric measures a negative $319 million, meaning that investors are queuing up to exit their spot position, overwhelming the liquidity and causing a price drop and subsequent future liquidation, which caused even more chaos. CryptoQuant also tracked whale wallets, and what it found is quite chilling, guys. Many whale wallets have deposited crypto to exchanges totaling around $400 million in January 20th. Some people attribute this spot market selling due to macroeconomics reasons and the Japanese bond losses. Based on CryptoSlate's Liam Wright, Tokyo bond holders lost a lot of money this week. Japan's 30-year bond yield shoot up to 3.5%, decreasing its prices. This is in line with the Bank of Japan's policy of increasing their interest rate to suppress prices. Right now, Japan is slowly withdrawing from becoming the source of cheap liquidity for the world. So why does this have any impact to Bitcoin? Well, actually for years, the world had operated with the yen carry trade in mind. You borrow cheap yen with almost zero interest rates and you sell it to buy something with bigger yield, say the US Treasury's bonds. And you repeat that. Essentially, what you meant is you're leveraging your bet that US Treasury bond yields will continue to outperform the interest payments for your yen debt. This makes it possible to invest more money than what you have into US bonds, increasing your profit. Yet now that interest rates in Japan had gone up, the spread between US bonds and the interest rate on the debt decreases, causing many to unwind their position, meaning selling their US bonds and repaying the yen debt. This causes US bond prices to dip as well and yield increase. With this massive deleveraging event, liquidity is being sucked from the market to pay off these debts. The second reason this affected crypto is that now institutions in Japan will be more inclined to invest in their government bonds rather than assets abroad. And Japanese investors hold a lot of foreign assets. This causes a major sell pressure on the world's market, exacerbating the issue. With the price drops, come as well institutions who look at the rising US bond yield, gobble them up, and causing liquidity to dry up even more in risky markets, including crypto. So essentially, in my opinion, this flight to domestic market by Japanese investors, unwinding of the Japanese carry trade, the onset of geopolitical tension between former allies US and Denmark over Greenland, and the high yield in US bonds caused liquidity to tighten as uncertainty increases. Bitcoin, as the global barometer for liquidity, is hit the hardest, along with alts bleeding against Bitcoin. If we look at BOJ's intention, it is clear that the current administration will maintain a higher rate than zero, meaning that the era of Japan being the provider of debt and a source of investors for foreign assets is slowly but surely ending. How will this affect the struggling Japanese economy? We will need to see more info about that in the future. But one thing is for sure, liquidity is tightening, guys. The era of free money is over. We have eaten future gains back in the pandemic era by printing money. Now we might need to repay that hubris for the rest of the decade. Buckle up, guys. I don't see it getting better before it gets worse first.